Are you in control of your debt, or is it in control of you? We are about to share with you a way to eliminate your debt quickly. Sit back, get a pen and paper, and write down any questions you may have. Once the video is complete, you will be prompted to view the live software in action by simply scrolling down to the video below. Let's dive right into the information. I'm sure you've heard of companies like Microsoft, Apple, eBay, and Starbucks. Their founders were awarded the Ernst & Young Entrepreneur of the Year award when they first started. They were seen as being a company having a viable product or service that would have an impact on our society. Recently, the founders of United First Financial received the same award in the financial services category for the Utah region. To put that into perspective, Ernst & Young is one of the top 3 accounting, tax assurance, and financial firms in the world. As a matter of fact, they were one of the 2 firms to handle our nation's $750 billion bailout package. This is a highly credible award. We have been acknowledged by several publications including True Wealth, Mortgage Planner, Success Magazine, and we received the Editor's Choice Award for 2008 from Personal Real Estate Investor. To explain what the Money Merge account is, let me first tell you what it is not. It is not a bi-weekly mortgage program. It's not a debt roll-down program. It's not just some concept or theory. And lastly, this program does not upset your budget. We have 4 key money-saving principles. The first one is strategic payoff. The second one is interest accumulation. The third key principle is interest float. And the fourth is interest cancellation. Here's what an amortization schedule looks like on a 30-year, $200,000 loan at 6% with a payment of $1199.10. If this client makes their payment as scheduled, at year 21 we can see they have gained half of their equity, yet they have paid more than they borrowed. So at the end of 30 years, they will have paid more than double the amount they borrowed. In other words, $431,000 on a $200,000 loan. Banks hold depositors' money as long as they can to leverage themselves. They wait until the last minute before dispersing funds to various accounts so they can, in the long run, hold on to every cent. This is how they continue to make profits. Now it's your turn to have a system that does the calculations for you, allowing you to use your banking systems to bank like a bank. Did you know that if you pay your mortgage on the 1st, when the bank asks for your payment, the bank will hold on to that money, gaining interest on it daily for 14 days, and apply that payment on the 15th? What if you let that same money work for you those 14 days? It's called time value of money. Our program has 24 pages of math algorithms working for you. That means that your software is tailor-fitted to your specific financial situation using existing banking tools at your bank. We just offer the software and education to get you out of debt the fastest way possible based on your unique situation. Let's discuss the first of the 4 money-saving principles, strategic payoff. Think about this. In what order would you pay one debt? Well, there's really only one way to pay it. What if you had 2 debts? You had a car loan over here. Which one would you pay off first? Well, you could pay the mortgage and then the auto loan, or you could pay the auto loan and then the mortgage. So there's 2 possible orders to paying those debts off. What if you had 3 debts? 3 debts, there'd be 6 different ways to pay that off. If you had 4 debts, there'd be 24 ways to pay that off. 5 debts? With 5 debts, you would actually have 120 different ways each month to get to the fastest way to zero. And only one of them, one of the 120, is the correct and fastest way. Finding the right order for the quickest payoff to zero involves precise calculations, not opinions. Factorial math simply calculates how many factors are in each equation. If you have 7 debts, that means you have a possibility of 5,040 combinations to guess which one gets you to zero faster and save you the greatest amount of interest. It is impossible to figure that out each month on your own. Why? Because this is recalculated each month when you have a change in the amount owed, interest rates, the ratio of principal applied versus interest paid, and many other determining factors. Fortunately, this software will factor all the correct math for you. Let me introduce you to John and Rebecca Jones. John and Rebecca make $5,000 per month net or after taxes, and they spend a combined $4,800 per month on all of their debts, expenses, and entertainment. This means John and Rebecca only have $200 left over at the end of the month. Do you need $200? No. You just need to spend less than you make, and we can show you as little as $1 left over will work. Here are their liabilities. John and Rebecca have direct deposit with the companies they work for, so their paychecks go into their checking account. The software prompts them to transfer that $5,000 from checking into savings. Now they have $5,000 in savings. So for the sake of demonstration purposes, realizing that everyone's situation is different, we are going to say that John and Rebecca can pay all their bills on their credit card or line of credit. We realize that the software will be customized for you and that your financial situation will be different from John and Rebecca. We are just keeping this simple so that you can understand the gist of how our program works. So they pay for their food, gas, and all of their household expenses, including all the bills shown here. Because their living expenses are $4,800, this means that they now owe $4,800 on that credit card or line of credit. The software now takes that debt into consideration and will address it the following month. You will notice that the debt amounts have changed because they continue to make their regular minimum payments as scheduled. So in month 2, their savings account paid John and Rebecca $12 in interest. Now they have $5,012 in their savings account. This is the second money-saving principle, interest accumulation. The software prompts them to take $37.89 from savings and transfer it into their checking account. After that, the software prompts them to take $4,800 and pay that credit card down to $0. We used someone else's money for 30 days and paid them no interest and allowed our money to work for us at the same time. This is the third money-saving principle, interest float. It then prompts them to take $39.89 from their checking account and pay towards their primary mortgage. And realizing that they still have money in their savings account, the software also prompts them to transfer $723 out of the savings into the auto loan. So this is what month 3 looks like. We now owe less on the mortgage and less on the auto.